What is debt to asset ratio? The debt to asset ratio is a financial metric used to help understand the degree to which companies' operations are funded by debt. It is one of many leverage ratios that may be used to understand a company's capital structure. The debt to asset ratio is calculated by using companies' funded debt, sometimes called interest-bearing liabilities. This refers to actual credit provided by direct lenders, for which there are interest obligations like bonds, term loans from a commercial bank, or subordinated debt. The ratio does not include total liabilities like accounts payable and etc. The example of debt to total asset ratio is number one, high leverage. The higher a company's debt to total asset ratio is, the more it is said to be leveraged. Highly leveraged companies carry more risk of missing debt payments should their revenues decline, and it is harder to raise new debt to get through a downturn. Number two is a low leverage. For creditors, a lower debt to asset ratio is preferred as it means shareholders to have contributed a large portion of the funds to the business, and those creditors are more likely to be paid. There is some good and bad leverage. So a financial leverage ratio of less than 1 is usually considered good by industry standard. A leverage ratio higher than 1 calls a company to be considered risky investment by lenders and potential investors, while financial leverage ratio higher than 2 calls for concern. So this is the example of high leverage. This example is a company with higher proportion of debt as a funding source is said to have high leverage. So this is the example of low leverage. Low leverage, this company is a lower proportion of debt as a funding source is said to have low leverage.
Hello everyone, so our topic is debt to total asset ratio. The debt to total asset ratio describes how much of a company's assets are financed through debt. It is also otherwise known as the debt ratio. This measure is closely watched by lenders and creditors since they want to know whether the company owes more money than it possesses. So the formula of the debt to total asset ratio is total debt to total assets is calculating by total debt dividing by total assets. So total debt divided by total asset is the formula. For example, sa assets, we have cash, accounts receivable, inventory, and equipment. Sa cash is 155,085, accounts receivable 20,000, inventory 6,700, and equipment is 10,000. So we add 155,085 plus 20,000 plus 6,700 plus 10,000. So ito na siya i-add, no? So ang total assets is 191,785. And sa liabilities, we have accounts payable, short-term debt, and long-term debt. So sa accounts payable is 885, short-term debt is 25,000, and long-term debt is 35,000. So same sa asset, ito siya i-add. 885 plus 25,000 plus 35,000 is equals to 60,885. So total liabilities divided by total asset is 60,885 divided by its total asset 191,785. Ito na siya i-divide. So ang mong gawas is 0.31. So bali convert na siya into percent. So we have 31%. That's our example. So a ratio that equates to 1 or 100% debt to total asset ratio means the company's liabilities are equally the same as with its asset. The company in this situation is highly leveraged, which means that it is more susceptible to bankruptcy if it cannot repay its lenders. A ratio that is less than 1 or a debt to total asset ratio of less than 100% means that the company has a greater assets than liabilities. This may advantageous for creditors because they are likely to get their money back if the company defaults on loans. A ratio that is greater than 1 or a debt to total asset ratio of more than 100% means that the company's liabilities are greater than its asset. In this case, the company is not as financially stable and will have difficulty repaying creditors if it cannot generate enough income from its assets. The debt to total asset ratio is a very important measure that can indicate financial stability and solvency. This ratio shows the proportion of a company assets that are financed by creditors through loans, mortgages, and other forms of debt. While it may be beneficial for companies to have lower debt ratios in order to attract investors, these numbers should not be too low because the company will need some level of funding in order to operate successfully.
Debt total asset ratio. Debt total asset Debt total capital ratio. Share the debt total asset ratio. Shows how much of the business is owned by creditors, people it has borrowed money from, compared with how much of the company's assets are owned by shareholders. The debt to total asset ratio is primarily used to measure a company's ability to raise cash from new debt. That evaluation is made by comparing the ratio to other companies in the same industry. The higher a company's debt to total asset ratio, the more it is said to be leveraged. What is the purpose of the debt to asset ratio? The total debt to total asset ratio compares the total amount of liabilities of company to all of its assets. The ratio is used to measure how leveraged the company is, as higher ratios indicate more debt is used as opposed to equity capital. What is a good debt to equity ratio? A higher debt to equity ratio indicates that a company has higher debt, while a lower debt to equity ratio signals fewer debts. Generally, a good debt to equity ratio is less than 1.0, while a risky debt to equity ratio is greater than 2.0.